So hello and welcome to our webinar on covering the basics of equity-based compensation. So we want this presentation to be as engaging as possible. So I encourage you to jump in and ask questions as they come up. You can use the chat function within Zoom. We have two members from our team, Jacqueline and Nicholas, moderating this chat, and we'll try to answer questions throughout the presentation. We will also be using a software called Mentimeter to ask questions to you and receive questions from you throughout the presentation. So we'll be pausing at certain times to field questions from the group. Please don't be shy. I encourage everybody to use the code that you see on your screen to join. You can join on your laptop or on your phone. And if you aren't able to join now, not a problem. At the top of every slide, you'll see the instructions on how to join menti.com. So I'll give everybody a minute there to log in because we do have a question coming up. All right. So to kick things off, what emotions come to mind when you think of your equity compensation? So in Mentimeter, you should see a prompt to enter an answer. And as you submit them, we'll see them pop up live on our screen. All right, uncertainty, worry, yes, common. Anxiety, very common. Regret, we're going to be talking to. Confusion, frustration.
I don't consider it part of my income. Interesting. Yeah.
Very good. This is all very much in line with what we see when we're working with people with equity compensation.
Yeah.
All right, so quick agenda. Since this is our first webinar on the topic, we're going to be focusing heavily on understanding what equity compensation is, and we're going to zoom in on the common forms of equity compensation. The taxation of this type of compensation is commonly misunderstood, so we will spend a significant amount of time reviewing the mechanics around this. Then we'll get into some of the common risks and pitfalls that we see when working with individuals on equity compensation plans, followed by some strategies to dealing with your accumulated equity. A small disclaimer before we start: understanding the mechanics and taxation of options is quite technical, but it's extremely important. So we're going to try to make this as exciting as possible, but there will be some numbers and some light math. So please bear with us in the first half of the presentation while we build out the foundation. So what is equity compensation? Well, it's when a company rewards its employees with shares of its own stock rather than regular cash compensation. And why would they do that? Well, giving ownership in the company often helps align the employee's financial interests with the success of the company. So if the company does well, the employee gets to participate in that. Another major reason is that it allows a company to pay their employees without using cash reserves. This is especially common and important for startups and early stage companies who do not have a lot of income to pay salaries with, but they want to attract talent. So back in the day, companies used to compete for talent by offering lucrative defined benefit pension plans. Nowadays, it seems like this trend has shifted a bit, and they're offering lucrative equity compensation plans. So there are several different types of equity compensation. Today, we're going to focus in detail on the two most common that we see, which are stock options and restricted stock units, which are commonly referred to as RSUs, and we'll refer to them as RSUs throughout the presentation. So another question for the group: what kind of equity compensation does your employer currently offer you? Stock options, RSUs, quite a few RSUs.
Yeah.
Share purchase plans as well.
Looks like we got a good range, but concentrated around the two that we're going to focus on today, which is great. Options and RSUs.
Awesome. Pretty good spread there. All right.
So as Lucas mentioned, we're going to spend most of our time today talking about the two most common types of equity-based compensation, those being options and RSUs. So starting with options, what is an option? A stock option is a financial instrument that gives you the right, but not the obligation, to purchase shares of a certain company stock at a predetermined price, regardless of what the market price is at the time for those shares. So there are 4 key dates to keep track of when it comes to stock options. And these dates are the grant date, vest date, exercise date, and sale date. And they can be visualized on the timeline on the screen. So the date that the options are given to the employee is referred to as the grant date. And the price that the employee must pay to receive the shares is the grant price. Options typically have a vesting period where before they're allowed to be used, which incentivizes employees to stay longer. And the date on or after which the options can be used is called the vest date. So typically what we see is options are granted in batches. So you might have the 2023 executive options grant, and that would maybe include 1,000 options. And those options would vest over in batches of 250 over each quarter. So by the end of Q1, 250 of those options would have vested. You'd be able to exercise them whenever you wanted. You wouldn't have to, but you could exercise whenever you wanted. At the end of Q2, the next 250 would vest, and so on. Then the process of actually taking that option and converting it into shares of the company, that's called an exercise. And so the date that you do that is obviously the exercise date. And then finally, when you wish to convert your shares into cash and sell them on the open market, this is called the sale date. And it's important to note that while we've laid them out on this nice clean timeline, the vest date, exercise date, and sale date can all actually be the exact same day. So if you were to exercise and sell your options immediately when they vested, which is something a lot of people do, those 3 dates would all be the same date, and those values would all be the same value. So let's take a look at a simplified analogy just to kind of get our heads around these terms. So your boss wants to reward you for your hard work. So he gives you a coupon for buying pizza. Coupon says you can buy a full large pizza for $10, regardless of what the price on the menu is. The coupon is valid after September 25th, so 1 month from now, and it expires in 1 year. On September 25th, you stroll down to the pizza shop and look at the menu. The price on the menu reads $50 for a large pizza. This is an expensive pizza. You smugly hand the attendant your coupon, pay the $10, and receive a fresh large pizza in return. Since you're not actually feeling that hungry, you agree to sell the pizza to your friends or maybe a passerby at the market price, which has since increased to $100. So the price of pizza is really going up. This place is really popular. Word's gotten out. They got really good pizza. So the price of their pizza is increasing fast. So you just made $90 because you had your coupon, allowed you to pay $10 for that pizza, and you sold it eventually for $100. So just to kind of tie this back to options, the date that your boss handed you the coupon, that's similar to the grant date. You couldn't use that coupon yet. It had really no value at that point, but you could, you knew that in a month, you would be able to exchange that for pizza. The date that that coupon became valid, so September 23rd, that's the vest, similar to the vest date for an option or an RSU. And the date that you actually use the coupon is similar to the exercise date. So that date that you went down to the pizza shop and swapped that coupon for actual pizza, that would be your exercise date. And then finally, when you sold the pizza, that's of course similar to the sale date. So a little thought experiment for the audience. If the menu price of pizza had been $5 instead of $50, what should you have done in that case? All right, looks like people are pretty certain about nothing. A couple saying they would use the coupon and hope the price goes up.
Wow.
And I don't think this crowd is going to be swayed. These guys are paying attention. That's awesome. So that's correct. The correct answer would be nothing. You wouldn't want to expose yourself to that sort of risk unnecessarily. Why would you use your coupon that allows you have a coupon that says you can buy pizza for $10, but the price on the menu is $5. So there's no need for you to use your coupon. You're not going to exercise that option. Of course, you could buy the pizza for $5, but that's a separate discussion. So before we get into the details of how these transactions are taxed, it's really important to note that the tax treatment depends largely on the status of your company at the time the options are granted. So if your employer, the company granting you the options, is what's called a private Canadian company that's not listed on a public stock exchange, you receive favorable tax treatment compared to options that are granted by a publicly traded company. So an IPO, or initial public offering, that's the date that a private company converts to a public company by listing its shares on the stock exchange for the very first time. And so for the purpose of this presentation, we're going to refer to options granted by private companies. These are typically, smaller companies, don't have their shares listed on an exchange. We're going to refer to them as pre-IPO options, and options granted by public companies as post-IPO options. So public companies, once again, these are companies that you're familiar with, most likely, like Nike, Tesla, Apple. Those are all examples of public companies, whereas private companies are typically less well known, don't have their shares listed on the stock exchange, but you get certain tax benefits by having options, or when you sell your shares of options that were granted by a company that was pre-IPO, that was not listed on a public exchange. So we'll get into those details really soon. So now let's switch over to a more direct example. So we had our kind of analogy pizza example. We're going to get a little bit more direct here. So just to see how this typically plays out. So in this example, I'm the CEO of a small tech company called Smart Tech that specializes in building apps for smart TVs. I hire Lukas, my co-presenter, to manage operations. Since the company is still growing and low on cash, I offer Lukas a modest salary in addition to 1,000 options on the company's stock. I tell Lukas this means he can buy 1,000 shares of the company stock at a price of $10 a share, regardless of what the market price is at the time. He just needs to wait 1 year before doing so. Lukas is excited, eager to build something special at the company, so he accepts my offer. Fast forward 1 year, and the company's doing great. Since the year has passed, the options have now vested, and they legally belong to Lukas. Lukas checks the stock price for our company on his phone and notices it has increased now to $50 a share. Lukas decides he'd like to purchase a car soon and logs into his online account to exercise his options, which are then converted into actual shares of our company. We're calling it SMTV is the ticker. He pays $10 a share, even though the market price is currently $50 a share. So he has that coupon, so to speak, that option that allows him to pay $10, even though anyone else who would be on the stock exchange would have to pay $50 a share at the current price. Now, a few months later, Lukas pulls the trigger on the car purchase and sells his 1,000 shares of SMTV, which is now trading at $100 a share. So it's doubled in price since he exercised. So he receives those funds to fund the purchase of his car.
All right, so now let's look at some of the taxation behind this event. And we'll first look at an example of options granted by a Canadian private company, so pre-IPO. And then we're going to contrast that to an example with options granted by a public company. And you'll notice a really key difference. So starting with the case of the Canadian private company, at the time that Travis granted me these options, there are no tax implications. A year later, when these options vest and they actually become mine to use, there are still no tax implications. Now, when I exercise these shares, there's no tax owing, but something called my security option benefit is locked in at that price. This value is going to determine my taxes that I owe later. When I eventually sell the shares, this is the taxable event. The difference between the grant price of $10 and the exercise price of $50 is something called a deferred security option benefit. And I'm going to receive a T4 slip from my company, just like regular income. The difference between the price on the date of exercise, the $50, and the actual sale price of $100 is going to be taxed as a capital gain. Keep in mind, this is all for pre-IPO options. Now, if we shift this and take the same example, but instead we assume that my company was already public when these options were granted, notice how the IPO date shifted to before the grant date. The only thing that changes as a result of this is that I have to pay the tax on the security option benefit in the year that I exercise the options. So this tax is not deferred until the point of sale. One of the benefits of having this income taxed when you exercise is that your employer has the obligation to withhold an estimated amount of tax, very similar to how on a paycheck they withhold an estimated amount of income tax. So although you lose the benefit of being able to defer this tax until you actually sell the shares, it's kind of nice to have one less item to track on your own.
So another quiz for the audience. When does Lukas have to pay the tax on his options if he received them before the company went public? So this is what we've been calling pre-IPO options granted by a private company.
Seeing a lot of response.
Yeah.
Got a smart crowd.
Yeah, no kidding. We're not going to fool these guys. Okay, man. That's good. Everyone's been paying attention. So that's right. When the shares are sold, these are pre-IPO options. There's no taxable event or tax owing, I should say, until those shares are actually sold. Moving over to the second example, when does Lukas have to pay the tax on the options he received after the company went public? So these are shares granted by a public company, publicly traded company.
Smart crowd, we're paying attention.
Yeah.
I appreciate the one person saying when I want to. I wish that was the case.
Awesome. So once again, correct. For post-IPO options, Lukas has to pay that tax right when they're exercised. He doesn't have the benefit of waiting until the sale like he would if these were options granted by a private company.
All right, so in the last few slides, we introduced a few key terms that are worth repeating. Now I'm going to go over these quickly because you guys answer those quizzes really well. But like I mentioned, for options granted by a private company, this security options benefit is locked in, but you have the benefit provided by the CRA to defer paying tax on this income until you actually sell the shares. Not the case for post-IPO options. Tax on this type of income is due when you actually exercise them. Like I mentioned, this type of income is reported on your T4 slip. On the bright side, though, this income is not fully taxable. So some conditions apply. However, in most cases, the taxable amount of the security option benefit is going to be cut in half due to a feature called the security option deduction. So this works in your favor. Now, if you're a resident of Quebec, in certain cases, this 50% deduction only applies to the federal portion of your taxes. On your provincial tax return, your security option benefit may only be taxed or may only be reduced by 25%. So your company's finance department should know the tax status of your specific company. So the best way to check would be to reach out to them and verify which tax treatment your company qualifies for.
I just saw a question along the bottom, just for us to clarify the difference between exercising and selling options again. So exercising, that's when you take this option you've been given, which is really just, a line item on a statement. It's a financial instrument, this option you've been given, and you convert that into actual shares of the company. So you now hold those shares just as if you went out onto the stock market and bought them. So you would hold them maybe within like a brokerage account or something like that. Whereas the sale, that's when you take those shares and actually sell them for cash. So that's kind of the difference. So I mentioned earlier, you can exercise and sell right away. So basically you're converting that option into shares and then you're immediately selling them on the market, or you can exercise and hold, meaning that you convert that option into shares of the company and then you're going to hold those shares of your employer until you wish to sell them. So that's kind of the difference there.
All right. So there is another exception. As of July 2021, if you're working for a publicly traded company and have over $200,000 worth of options vesting in a given year, only the first $200,000 of options will qualify for the security option deduction. On all options over this amount, the full security option benefit is going to be taxed at your regular tax rate. So let's look at a quick example just to highlight how this is calculated. Let's say your employer grants you 3,000 options that are going to vest over the course of 1 year when these shares are trading at $100 a share. In the eyes of the CRA, this counts as $300,000 worth of options being granted to you. When you eventually exercise these options, only 2,000 of these options will qualify for the 50% deduction. The remaining 1,000 options will be subject to tax at your full tax rate, just like normal income. And what's interesting is that it doesn't matter what the price is when you eventually exercise and sell your shares. The $200,000 threshold is locked in when these shares are granted. So that's why we're using that $100 price. Doesn't matter what happens in the future. All right, so the moment we've all been waiting for, some tax calculations on a Friday afternoon. After this, I promise we can get through the rest of the presentation without mentioning taxes too much. So let's walk through a quick calculation for a single stock option. We're going to piggyback on the example that we used before. So we'll assume the options have a $10 grant price. When you exercise the options, the market price is $50. And when you sell the share, they're worth $100. We're going to throw in an assumed tax rate of 30% to help illustrate these numbers. So when you exercise, the tax calculated at this point in time is going to be equal to the market value in the shares when you exercised, $50, less the grant price you pay to actually receive the shares, $10. And this $40 difference is going to be taxed at half of your normal tax rate. In other words, it's 50% deductible. This works out to $6 of tax. If you end up selling the shares at a higher price, this creates yet another taxable event. The difference between the market value when you sell the shares, $100, and the market value when you exercise them, $50 in this case, is a capital gain. And once again, this is taxed at half of your regular tax rate, because capital gains have preferential tax treatment in Canada. This works out to an additional $7.50 of tax. Now, this is a good time to make an important note. If the share price were to have fallen instead in between exercising and selling, you would be in a capital loss position. This capital loss can be used to offset capital gains going back 3 years or carried forward indefinitely to offset future capital gains, but it cannot be used to offset other forms of income, such as the security option benefit. And just to wrap up this point, we can take a quick look at this visual, which summarizes all the various costs and taxes that erode some of your proceeds. So in this example, of the $100 of proceeds, only $76.50 ends up in your pocket to take home. So we have $10 going towards the exercise costs. So that's what it costs to actually get the shares. Then you have $6 going to tax triggered by the option benefit, and $7.50 going to tax triggered by the capital gain. If your company uses a platform like ShareWorks, there's going to be calculators to help estimate the after-tax proceeds you'll receive. But just be aware that not all the numbers that you see on a platform like ShareWorks are shown net of tax and net of exercise price. So let's take a pause here and we can field some questions from the audience, see if anybody has any questions related to what we've gone through so far.
I know Jacqueline and Nicholas have been busy in the chat, which is awesome.
If there isn't anything, we can move on. Wait a couple more seconds. There's got to be some questions around tax. Okay, a cashless sale. So a cashless sale or a cashless exercise, that is when you pay for the exercise cost and tax by selling units or selling shares rather than sending your company a wire to cover these costs. So effectively, you would receive the net amount of shares, or if you do a sale at the same time of exercising, the net amount of proceeds in your pocket at the end of the day. So in that chart that we previously showed, all of that buildup of costs would be paid for by selling off shares rather than you paying out of pocket. More questions here. This question here, is there a bar where they're not taxable for public companies? There would always be tax paid on them. Like Travis mentioned, there is a distinction between Canadian-controlled private companies and public companies, where the taxation, like the manner of taxation changes, but there should always be tax paid on this type of income. Perhaps you're thinking of the $500 million of revenue, which differentiates a small company from a large company from this tax perspective. Like you can be a private company with over 500 million of revenue, and that changes the manner in which you're taxed, but there still is tax paid. Cashless sale we did.
Assuming I've exercised and not sold my RSUs, these convert to shares, but do not earn me dividends. You would earn dividends on these shares. They basically, it's as if you own the shares, just like if you'd purchase them on the stock market. So if those shares are dividend paying shares, you would receive them just as if you'd purchased them normally.
Yeah, so that depends more on your company's dividend policy, but Travis is right. Like if your RSUs vest and you receive, let's call them Class A shares, and those Class A shares happen to pay dividends, you would receive those dividends. The restrictions of restricted stock units only apply prior to them vesting and actually becoming yours. What happens if the exercise price is lower than the grant? That's a good question. If the exercise price is lower than the price on the grant date, this stock option deduction does not apply. It'll be taxed fully as regular income. Very good question. So most companies will not do this because they want their employees to benefit from the stock option deduction. So they will set the exercise price at or above the grant price. That way that they can qualify for that added benefit. But if that was not the case, you could be in a scenario where the full security option benefit is taxable, no deduction. Travis, do you have an answer for this one?
For 500 million revenue or less for non-CCPC. I'm not sure what the question is on this one.
Maybe we can get back to whoever asked this question. We're going to have links at the end of this. So if you guys have questions, you want to have a quick chat, we're happy to jump on it and answer some more questions.
Awesome. Okay. I think. Sorry, was there one you were going to answer there?
No, I was going to say that last question about RSUs. We're about to dive into RSUs. Okay, so perfect timing.
Yeah, feel free to keep funneling questions into the chat. Jacqueline and Nicholas can jump on those, and like Lukas said, we'll be available after the presentation as well. If you want to send anything our way. So we've been talking most of the time up until now about options, stock options. The other half The second most common, or maybe the most common form of equity compensation is RSUs, which, as we've mentioned, stands for restricted stock units. And the restricted, that word is in there because they don't convert into actual shares or carry any voting rights until after the vest date. So going back to our pizza example, RSUs are more like if your boss gave you a gift card for free pizza. So you don't have to pay anything for that pizza. It's just delivered to your front door. From there, you get to decide if you want to sell the pizza to your friends or hold it for the long term. Now, the analogy kind of breaks down here because we definitely don't recommend holding pizza for the long term, but you get the idea. So to put this on our timeline, we have the grant date, the vest date, and the sale date. And now note the difference between this timeline and the option timeline is that we have no exercise date. And that's because you don't have to exercise RSUs. They simply convert from RSUs into shares of the company on the vest date. And so the difference between $0 and the price, so like the fair market value of those shares on the date that they vest, that'll be taxed to you as regular income, just like your employment income does. So there's no stock option benefit in this case. It's just all taxed to you as income. If you choose to hold the shares after they've vested and converted into shares from RSUs, and then sell them later at a higher price, that'll be taxed as a capital gain, just like if you had gone out and purchased those shares on the market on the vest date. So just a quick summary to kind of compare the options to the RSUs. So while they both are very similar in that they offer you rights to stock ownership, they have a couple key differences. And the first is that in order to convert options into actual shares, you have to pay that grant price. So it's not a free lunch. You have to pay that price compared to RSUs, which, like I said, are like a gift card. You just get those shares on that vest date. You don't have to pay anything. The second difference is that RSUs are taxed immediately upon vesting as income. So like I said, on that vest date, the fair market value of those shares, that'll be taxed to you as income. And if you decide to hold the shares, any growth afterwards is taxed as a capital gain. Whereas options are taxed at exercise if they're post-IPO and at sale if they're pre-IPO, taxed at half your normal rate. So you have that security option benefit and the deduction, and then any capital gain for after the exercise.
All right, so now that we've covered the mechanics of options and RSUs, let's move on to how to think about these assets in the broader context of your financial picture. So to start, we're going to have to address some of the major biases and risks that come along with holding equity of the company that you work for. So when we hold an asset, it's very common to place a higher value on it than we should. And this tendency for us to value an item more highly simply because we own it is called the endowment effect. So when you're granted options or RSUs from your company, you become endowed with the ownership of those options or RSUs. And this psychological attachment or sense of ownership can create a reluctance to sell them. So I find a good question to ask yourself is, if you were gifted the value of your options or RSUs in cash today, how much would you allocate towards your company's stock? So let's say you have $800,000 of options or RSUs, and you were gifted this $800,000 in cash instead. How much would you invest in your company? Oftentimes I find when it's framed this way, people realize that maybe they would put some into their company, but maybe it wouldn't be the full amount that they have at the moment.
Next, we have status quo bias. And this refers to our preference as humans for maintaining the current state of affairs rather than making changes. So I totally get it. Change is tough. And every action kind of feels like the possibility of regret. So it might be easier mentally or cognitively to just not make an action. You've been given these options or be given these RSUs as part of your compensation. And kind of the default path is to just hold on to them until you're forced to do something with them. So even though it might make better sense from a risk management perspective or a financial perspective to, exercise and sell, it's a lot easier a lot of the times because of the status quo bias to just hold on and to not change things.
And very similar to the status quo bias, you may be more influenced by the fear of regretting a wrong decision, which can often paralyze people's decision making. So it's important to note that regret can happen on the upside or on the downside. If the company does well, somebody might regret selling earlier. If the company does poorly in the future, they may regret not having sold at the top. What ends up happening is that, not knowing what's going to happen in the future, people get overwhelmed by these possibilities and they end up doing nothing. Now, we often hear, what if this is the next Facebook or Amazon or Apple? And this is actually a very valid consideration. Minimizing regret is an important lens to apply when trying to decide how much of your company's stock to hold or sell. And so holding on to some stock to ensure that you have that feeling of participating in the growth can be a rational decision. So this risk shouldn't be completely ignored, but you should recognize how it may be affecting your financial decisions, and you shouldn't let that outweigh the potential risks on the downside.
So another bias is the illusion of control. And this is our belief that we have more control over external outcomes than we actually do. And this is super, super common in the case of, executives or high-level employees working at a company when they're getting paid in company stock. So you might be really deeply involved in some really exciting projects. A new product is about to be launched. It's going to be killer. It's going to destroy the competition. You're just thinking, the sky is the limit for this company. But this emotional bias can really lead to overestimating your ability to predict or influence the stock's future direction. And that can result in a hesitancy to sell or exercise the option based on, that belief that your company is special, what's going on. It's going to, it's just going to go straight up from here. But the market doesn't necessarily, to be frank, the market doesn't care. The market is going to price all of those things in, and you have significantly less control than you might think. And there's always going to be things that are just totally outside your field of view, things that you couldn't even control if you wanted to, like other companies' actions, new revolutionary technologies, things like that.
The last one we'll look at is the familiarity bias. So this is the tendency for us to favor investments or assets that we're familiar with or that we have personal experience with. And it's extremely easy to confuse familiarity with safety. So when you know the long-term plans of your company and the leadership treats you like family, it's much harder to objectively assess the risks of owning the stock. And this is especially true if the stock has gone up a lot over time. This bias can lead to a preference to holding onto the company's stock, even if it may not be the most rational decision from a diversification or risk management standpoint. So after going through those biases, I'm curious which of these resonate the most with you, and you can select multiple answers here. All right, a little bit of everything so far. Regret, nice. Status quo. A lot on the regret side. Very, very common.
Yeah, for sure.
Awesome. I think one big takeaway is that you're not alone in if you're worried about regret when it comes to your stock options or RSUs, you're definitely not alone there.
Yeah, absolutely. Awesome. So outside of those biases, there's also risks. And one of the biggest ones when it comes to equity-based compensation is idiosyncratic risk. And what this is really a fancy term for company-specific risk. So you may have heard before that diversification is a key principle of risk management and investing. By holding stock solely in the company that you work for, you have a high level of concentration. If the company faces financial difficulties, a decline in the value, or even a complete failure, your financial well-being is going to be significantly impacted. And that's the case that we see on the left side of the screen here. So this individual has all of their net worth within their company that they work for. Something happens at that company, it's probably completely outside of that employee's individual control. And now that's going to have a massive effect on their net worth. Whereas the individual on the right has diversified their investments, diversified their net worth across multiple companies. And now, same situation, something happens at that company, that's going to have a much smaller impact on their net worth overall. And so to bring a more specific example of this, an employee working at Volkswagen may not have thought that owning shares in one of the world's largest auto manufacturers would be overly risky, right? I work for Volkswagen, they make great cars, they have great funny commercials, really good product, they've been around for a long time. But then all of a sudden news breaks out that they've been fraudulently reporting their emissions data on their cars. Now, this is totally outside of the control of 99% of the employees at the company, but this would have had a dramatic effect on someone's net worth. Their net worth would have plummeted by around 40% in a matter of days if they had all of their net worth in their Volkswagen stock. So the auto industry as a whole was, for the most part, unaffected. Companies like Ford and GM, they were fine. The market as a whole, so the broader stock market, would have been mostly unaffected by this, but something very specific to the operations of that company might have caused this person to lose everything they've worked for in a matter of days.
So another major risk along the lines of having all your eggs in one basket is the risk of concentration between your human capital and financial capital. So human capital refers to the skills, knowledge, and expertise that you have and that you use to generate income. So the greater your future earnings are, or your future earning potential is, the greater your human capital is. Financial capital, that's nice and simple. It's your savings or your investments, your bank accounts, and together those form your true level of wealth. When you hold a stock in your own company, your human capital and your financial capital become heavily concentrated in that company. So this concentration can amplify the risk of financial loss that Travis mentioned if the company encounters difficulties, because let's say in a worst case scenario, such as bankruptcy, not only would you lose your financial investment, but your employment and future income could be at stake as well. So a good example of this is Canada's once tech darling Nortel. Nortel was a massive company. At its peak, it made up around 35% of the Canadian stock market. However, when the tech bubble burst in the early 2000s, many tech stocks, including Nortel, saw a severe decline in price. This, of course, led to significant financial losses for employees who held stock options and RSUs. But to make the situation even worse was that many employees were laid off. And those who relied on the company equity as a large part of their savings would have been left without a job and potentially without sufficient savings to support their lifestyle while they looked for a new job. So it's an extreme, but a really clear example of how dangerous concentrating your investments and your income in the same company can be. So what should I do? Let's look at some of the common questions that we get.
So a lot of plans will offer employees the option, no pun intended, to choose which type of compensation they would prefer. So you might be able to choose a blend between RSUs and options and cash. So obviously, when comparing these choices, it's important to know the differences between these two methods. So as we've discussed, options require you to pay the grant price in order to receive the actual shares. Now, this puts them at a disadvantage when compared directly to RSUs. So to compensate this, most companies will offer a multiplier on the options. So for example, you can choose between 1 RSU or 3 options. Now, in general, assuming your company offers this multiplier, if somehow you knew that the stock price was going to appreciate significantly, you would want to choose options, or you'd want to tilt your allocation more heavily towards options, because you'd have more units, more shares to capture that growth and the growth would be taxed more favorably. If you thought the share price was going to stay relatively flat, you would choose RSUs. And if you thought the share price was going to decline, you would choose the safest option, which is cash. Now, just big caveat here, there's no way that you would possibly know with definity which of these options was going to happen. If you could predict that future, you'd be a very wealthy person. But if you're trying to base your decision on where you think the stock's going to go, those are kind of your three options.
So another question we get is, should I exercise my options and simply hold the shares? And typically, it would not be beneficial to voluntarily exercise your options early and hold the shares. Remember that the options provide you with the ability, but no obligation to buy the shares at a set price in the future. So there's value to keeping your options open. If the share price falls below your exercise price ever in the future, these options would become worthless. Remember, why would you pay that higher set price when you could simply buy the shares on the open market for less? And you would simply choose to not exercise. This is an unfortunate outcome, of course, but you aren't out any money out of pocket. And this is the example that Travis is in on my slide on the left-hand side. So he still holds the options, not the shares. Since he hasn't exercised the options, he has not paid for anything out of pocket. His net position is 0. Now, for me, on the other hand, on the right-hand side of the slide, if I had chosen to exercise the options and paid $100 for them, and now they're only worth $50, I'm now in a loss position. So another reason not to exercise them is also the triggering of the various tax events that we discussed earlier in the presentation. It's better to push paying off this tax as far as you can, and that's typically to the point of sale. With all that being said, there are some unique reasons where it would be logical to exercise your options regardless of your plans to sell the shares. So the first one, if you leave your company, you will likely not be able to take your options with you. This will force you to exercise them, and you may choose to still hold on to the shares if you aren't ready to sell. Options also have a set expiry date. So this means that at some point in the future, there will be a date where you're forced to make a choice to either exercise your options or give them up for free. If the share price is above the exercise price, you would likely choose to exercise them, but you may not be willing or able or ready to sell those shares yet. If you're moving to a province like Quebec, which might have less preferential tax treatment, remember earlier I mentioned that Quebec does not always allow for the same preferential tax treatment on the provincial side of their taxes. There could be a benefit to exercising your options while you're still a resident of your original province. Now, this advances tax that would otherwise not be due. So this calculation is not straightforward, and it's not a one-size-fits-all answer, but you and your financial advisor should consider this. So what if I'm an executive? Obviously, many individuals awarded with company equity are high up in their company. If you're in possession of material, non-public information, you are not permitted to trade securities. Many companies take an understandably cautious stance when there's even a slight chance that an employee is in possession of non-public information. So this puts high-level employees in a really tough spot because they might never be able to sell. So luckily, there's something called an automatic securities disposition plan, or ASDP, as they're commonly referred to. And this is a legal agreement that allows for pre-planned sales of securities with a predetermined schedule and set of instructions. So a plan like this allows insiders, such as executives, board members, directors, to safely liquidate securities without a risk of breaching securities laws. And it's important to note that this contract has to be drafted well in advance of any planned sales. And also in the US, there's a very similar system, and it's referred to as a 10b5-1 insider trading plan. Finally, we have the million-dollar question: do I hold on to my equity or do I sell? And as much as I wish I could provide a magic answer, I can't. But what I can do is hopefully help provide a framework for thinking about this decision. So this decision should be based on asset allocation and risk regret optimization, not speculation in terms of where you think the price is going to be in 1 week or 1 year from now. So I really encourage you asking yourself questions like, if a price decline were to occur, how much would I be willing to lose? Or on the flip side, if the price were to increase, would I regret not holding anything? What percentage of my net worth is already diversified? Or how much impact would a severe drop in price have on my financial plan? So when we're helping individuals make decisions around selling equity, we try to link it back to a goal, such as financial independence. That's a really common goal people have. If you have an idea of what level of income you need to live a happy and healthy life, then we can work backwards to determine how much you need to have set aside in a diversified portfolio to provide you with that level of income. And then we can create a plan to work towards filling that bucket through periodic sales of shares. It also often helps to make a rules-based plan. That way you avoid a lot of the behavioral biases and temptations that we talked about earlier. Even if you're not an insider, drafting your own mock automatic disposition plan can be of really huge value.
So that concludes the formal presentation for today. We just want to open it back up to the audience for questions one last time. We'll also be sending out an email afterwards that'll have means of getting in touch with us and asking questions, and also providing any feedback. So don't worry, this isn't your last chance to ask questions. I think these are mostly right now questions from the last time.
Let's answer these ones. I think we have some new ones coming in. So when drafting an automatic disposition plan, how far should I let my options go into the money before I start selling? It's a difficult question because you won't really be at the, you'll be sort of at the mercy of markets to when you end up going to sell, because you're going to be setting this plan up in advance and you won't know what the market price will be when you're selling those options. And that's sort of the idea behind the ASDP plan, but you won't really be in control at that point in time. As long as your options are in the money, there's technically going to be net proceeds going into your pocket. There's probably some small fees charged by ShareWorks that will eat away at a little bit, but assuming they are in the money by, a material amount, call it more than $100, there's technically money that you'll be netting from it. So there's no magic number of how far to let your options go into the money before exercising.
Here's if options tank after they were exercised, you still pay tax on the benefit, i.e. you're paying tax on something you didn't end up benefiting on. So yes, this is true, and can be especially detrimental when it comes to pre-IPO options. So something that we've seen in the past is, you're granted shares at a very low grant price. So, you barely had to pay anything when you exercise those shares, but the price when you exercised, which we would call your exercise price, was maybe really high. So in that case, that's what your tax liability is going to be based on. And yes, even if the price declines significantly after that, and dips way below the exercise price, you do still owe that tax. So that's why it's important, as Lukas mentioned, to, as much as you can, try and sell as close as you can to the exercise, or exercise and sell when you can, rather than, having that gap. You're opening yourself up to more risk.
Yeah. And technically you do end up getting that money back when you trigger a capital loss. You'll be able to apply it against future capital gains. But I mentioned this earlier in the presentation, is that you can't use that capital loss to offset other forms of income like the security options benefit. So there can be a mismatch where you trigger a large security option benefit, you're taxed on that, and then you capture a capital loss. You still need to pay that tax for the security option benefit in cash upfront, and then you don't benefit from that capital loss carry forward for potentially many years down the road. So there can be a mismatch there for sure. Let's look at another one here. Is there a rule of thumb for how large a percentage of your total portfolio your employer stock can be? There is no magic answer, unfortunately. It's a lot of it comes down to your financial plan, your financial goals. And let's take an example of somebody who it might make sense, or it might not be too detrimental to have a large part of their portfolio in their single company. If you have low spending and you've already diversified enough to cover those spending needs, and you don't get much value out of spending anything more, then everything over and above that amount of money that you need to live that happy lifestyle is really up to you, and you can take whatever risks you want with that money. Be aware of the downside potential. If it goes to zero, it goes to zero, and you're left with what you've diversified. But that could be a case where somebody might have 90% of their portfolio in a single company as sort of maybe a lottery ticket. Maybe they just want to, really feel attached to their company. But if their lifestyle only requires 10% of their portfolio to live off of, it could, in theory, make sense. Now, that's an extreme example. But yeah, extreme example for sure. But there is no magic number, unfortunately. Right. So we're coming up on time. We probably have time for one more answer. Oh, we've got a clarification here. Okay. To clarify my question, assume options are in the money, but only by $1. Should I exercise and sell? Okay.
So the ASDP question.
Yeah, this is so $1, like that's not overly material. Like you have to look at the transaction costs it would take to exercise. Obviously, there's the exercise cost, but there's some really small other costs as well. Like I know that ShareWorks is the most popular platform, so I'll speak to ShareWorks. They do charge a fee to actually make that transaction. It's relatively low, but if your shares are only in the money by $1, that might erode the full return. So in this extreme example, I would wait a little bit till they're more in the money. That way, small transaction costs aren't eating away at your net proceeds. Similarly, when you actually wire the funds to your bank account to get your net proceeds, there'll probably be a $25 wire charge associated with that. So just be aware of those fixed costs that could erode your returns. But in theory, if the shares are in the money, there is net proceeds available to you.
Awesome. Okay. I think with that, we'll move on. Hopefully you have a little bit more clarity for yourself when it comes to your equity compensation and how it's taxed. As you can see, these can sometimes be fairly complex, and there's a lot of nuance to these discussions. So we definitely recommend speaking to your financial advisor and or accountant before executing transactions, just to make sure you're aware of any implications. My Calendly link and Lucas's Calendly link is going to be posted in the chat below by Nicholas. Feel free to book a time to chat with us at your own convenience using those links. We're also going to have a link in the chat for a feedback form, super quick. You can also scan the QR code that's on the screen. We absolutely treasure your feedback. Would love to hear more about how we can make these presentations better, or maybe topics that you'd like to hear in the future. If there's enough interest, we can definitely do a more advanced version of this presentation where we maybe get into some of those more intricate situations or kind of one-off things. So definitely let us know if that's of interest to you there. And finally, you'll also be getting an email afterwards with some more information on how to connect with us, just in case you miss these. these links here in the chat.
And if we didn't get to answering your question, we do apologize, but please use those links to reach out to us. We're happy to chat offline.
Absolutely.
I think with that, we'll conclude our presentation.
Thanks so much for coming, everyone.